the medium and heavy commercial vehicle industry has seen distinct signs of growth in August after declining for around 30 consecutive months. So is the CV cycle finally recovering, and is this a harbinger of a recovery in the economy itself? We asked one of the keenest watchers of both the CV space and the economy, Romesh Sobti, Managing Director and CEO of IndusInd Bank. Good morning, Mr. Sobti. Good to have you with us. It's been a long gap. And first of all, congratulations. I guess congratulations are in order. A renewal of the tenure is on the cards.
Well, I think all senior citizens in banking should be happy at this sort of vote of confidence that RBI has given to the boards of private sector banks.
Okay.
But certainly, yes, I think there's clarity now. And as far as I'm concerned, if the board invites me to work for another 2, 3, 4 years, I'm more than happy to work.
When does the board actually meet to do that? I thought your term would have ended in February if the Reserve Bank had not given this order. So by February, we should hear from the board?
Yeah, I think the sequencing is that the board then sort of meets and decides the tenure and then sort of sends off the application, because the RBI renews it 3 years at a time. So I think that's the sequencing, and so we have time up to January end of next year for that to happen.
Okay. Mr. Sobti, good morning and thank you for being with us.
Morning.
What is the sense you're getting about the commercial vehicle space itself? Are things picking up on the ground? Have disbursements gone up?
Yeah, I think all the vectors that indicate a revival of demand are there, and so we watch vectors like, for instance, hardening of freight rates, one end, the increase in number of inquiries for commercial vehicles, that's the other one. So these vectors are looking up. Days usage, which is a very critical, how many days is the truck used on an average in a month? I think that's days usage have also gone up. So all that, and the manufacturer data is also indicating to that. I think that is a marginal improvement in disbursements, but we have not seen the sort of wave come. Of course, you know, this quarter is always it's a monsoon quarter, and then the charades and all that. But I expect that September will be better than August, and I think sequentially every month should actually improve. And quarter 4 is what we really expect a real pickup in demand.
Okay. So already, I guess in the current quarter itself, you expect your bank in particular and the banking sector in general to have lower pressure of provisioning, you think?
See, what has happened, Lata, is that especially in this part of the business that we do, which is really the vehicle financing part of it, for the first time in quarter 1, we saw our slippages actually reduce, go down.
Okay.
So I think that as disbursements increase, collections improve. So there's a linearity of relationship there.
Okay.
And we expect that over the next 3-6 months, credit costs on this part will definitely fall.
So how much could the loan growth be, sir, if you do see a recovery in the CV sector? I understand that your corporate book has been growing quite well, almost 40%, but the CV loan book still is quite sluggish. What do you expect going ahead?
Yeah, so our book has got a little unbalanced as a consequence. We've always wanted that 50-50 breakup between corporate and retail is the high yielding book. It's got a 4% higher yield. So that's now slipped to 57 corporate and 43 on the this thing. Actually, the retail book is flat because the disbursements are equal to repayments. But I think from next quarter we'll start moving, and we'll start seeing rebalancing of the book up to the 50-50 over 12 months, and which means some improvement in margins.
Okay, 2 people have cut deposit rates. You on your savings side, and Mrs. Bhattacharya, that is SBI, which came yesterday. That is the 1 year to 3 year, which clearly is their benchmark, their way of saying that we are going to pay less for money. How are you reading the tea leaves? First of many such things to come. You told me in the break that there are other moving parts.
Yeah, you see, I think the 2 rate cuts that you mentioned are for 2 different reasons.
Okay.
So clearly, I think the chairman of SBI has said that they're flush with liquidity, and I think that reflects also in the market that deposit growth is higher than loan growth. In our case, of course, we raised the savings bank rates 3 years ago, and much water has flown under the bridge there. The franchise has grown. We were 250 branches. We are headed towards 700 this year. The number of customers that come in and walk in now has increased tremendously, and we're cross-selling a lot of products now to this segment. So in this slab we found that there was a higher degree of stickiness, And that's why we reduce rates, which are still 0.5% higher than most of the competition. But the moving parts piece that you mentioned, Lata, is really on this credit growth and deposit growth. So I think the base effect has to be taken into account, because last year, Q2 was post 15 July,
Yes.
where the market suddenly dried up on commercial paper and the debt markets, and a lot of it came into the credit markets. So that has to be taken into account. And this quarter here on the deposit side, there's been an inflow from the debt side because of the budgetary changes.
Okay.
So I think both these have to be taken into account. So next quarter, let's see whether the trending is maintained.
Oh, that's interesting. What you're saying, therefore, is that, if anything, the flushness of the liquidity is going to continue.
Well, some of this may actually go back into equities, and we are already seeing that trend. So, for instance, the deposit flows that happened because of the debt inflows, some of it has actually gone into equities as well. So, I think a firm trending has got to be seen. Let's see next quarter, Q3.
Okay, that's interesting, Mr. Sobti. You mentioned just a while back that you expect to see an improvement in margins because of all of this. One analyst has put out a note where they believe that IndusInd Bank could see 4% net interest margins by the end of FY16. Is that a doable target?
Well, aspirationally and arithmetically, it's doable. But I think there are moving parts here as well. Aspirationally, we've always said that we have the highest gross yields in the industry, and as deposit rates go down, our fixed rate book, which is a vehicle finance book, gives you expansion in margins. So we touched a peak of 3.75. Hopefully the next peak is higher than that.
Okay. Well, I wanted a word more on recovery, since you pointed out to the number of vehicle days that are getting used. If you actually looked at the IIP numbers, I mean, not the most scientific of indexes at all, but although we speak of an improvement in the index, 3.4% in June, okay, July was just about 0.5%, the index actually is at still 170, and 3 years ago in 2011-12, the average index level used to be 166, 168. So over 3 years, we are just at 170. It seems like only the contraction is getting corrected, but fresh growth hasn't yet come according to these indexes. What is the sense you're getting? Is it that extraordinarily depressed usage of vehicles are now getting corrected, but the courage to ask for new vehicles is not quite coming in?
Well, I think part of that courage is reflected in the inflow of inquiries.
Okay.
It doesn't immediately translate into this thing, So there are three sectors really that will pull vehicle demand. There's the bus sector, which is the passenger goods, then the goods sector, and then there is the infrastructure sector. Infrastructure sector we haven't seen pull up. Buses, certainly we've seen some very large orders for buses being placed. For instance, Ashok Leyland said that they are sold out on production for the next 3 or 6 months. So I think there is a lag effect there. And as far as the IIB figure is concerned, I don't think this is a secular sort of a recovery. There are some cyclical upturns that are happening on the auto sector. Yesterday I was reading about auto parts sector also increasing the hiring and things like that. So all these are sort of green shoots. But I think they will take time to actually reflect in the disbursements in the books of banks.
Okay, so what is the contribution, just to understand, what is the contribution to your total loan book from the commercial vehicle sector, and within the loans, how much actually comes from the OEMs and how much from, maybe some of the other suppliers as well?
So, 43% of our book is actually retail, and of which about then 40% is vehicle financing, not commercial vehicles. So we do everything on wheels, from 2-wheelers to 16-wheelers, right? And we have a dominant sort of a play even in 2-wheelers, for instance. Commercial vehicles per se are about 19% of our book, and the distribution of financing is very well spread out across the manufacturers. But the two manufacturers, Ashok Leyland and I think Tata Motors, dominate. There are other players like Volvo and the Bharat Benz and things like that will also play.
Okay.
So most of it is new vehicle financing for us in that sense. So it is actually original equipment manufacturer financing for us.
Okay.
All right.
Finally, Mr. Sobti, what may you do by way of credit offtake loan growth this year, you think?
Well, I think, Mother, that in the best of times we grew between 25 and 30.
Yes.
And in these tough times we have grown between 20 and 25. So I think we are likely to maintain this trajectory of being between 20 and 25, more towards the 25 than the 20. And as the vehicle finance momentum picks up, rather than showing a higher growth, we will start rebalancing the book, you know, through sell down of the corporate book.
All right. Okay, actually two bankers have shown 25 to 30% growth and in the worst of times still done 20 to 24% growth. Both of them are going to be with us for another 3 or 4 years. Thank you very much, Mr. Sobti, for joining us in that discussion.